Right, been a while since we've spoken. Colin, FX Trad, and Richard, of course, and Syed. Good to see you here, and Suhan. Yeah. Well, guys, what we're going to be talking about this morning is the ongoing currency wars. Now, you can see on my website there, tradersclass.net. Have you heard all about the currency wars? Well, if anyone hasn't heard about the currency wars, where have you been? Because we're in a game. The markets are playing a game, and the markets are being driven by central banks all around the world. And the game at the moment, as so many of us do know, is it's about weakening a currency. Now, I actually had an email conversation going on with one of my new members recently, and and she was asking, why is it that there seems to be this mad dash to reduce the value of one currency in relation to another? And as I explained, it's all about trying to get some competitive advantage. Now, business is all about competitive advantage, and you want to do everything you possibly can. And when you're looking at a country, which is really just a conglomeration of a number of companies, a number of businesses who all want to get competitive advantage over another country, then there's something that can be done. You can play around with a currency. You can either increase its value or you can decrease its value. And if you increase the value of a currency, then what that will do is that it will have the effect of meaning that your exports are going to be at a different price to what they were when it was somewhat weaker. So if you weaken your currency, then it will mean that your exports are going to be more attractive. They're going to be cheaper. They're going to be cheaper for others to buy. And that's exactly what this game is all about. It's providing competitive advantage so that your own organizations, your own companies will have that competitive advantage over other countries, organizations and businesses. The consequence of all of that is that you will get a short-term boost. Now, there's another side of the coin, because if your exports are going to become more competitive, your imports are going to have exactly the opposite effect. And if your exports are actually made up out of materials, raw materials that you have to import to then produce into these items that you export, well, you're not actually gaining a great deal. You're not gaining a great deal. So we've effectively got what has been described as a race to the bottom with currencies. Now, what we've seen is that the Japanese yen has been one of the main currencies which has moved really, really quite substantially. And if we just take a glance at the Japanese yen chart, let's just move over to the Japanese yen, if it'll present itself. Get the right one. We've got this weekly chart then of the Japanese yen, the US dollar against the Japanese yen. This is the spot chart. It is showing that the US dollar has gained massively against this ever weakening Japanese yen. Now, one of the main reasons behind that weakness then is the QE effect and the way in which the Japanese are effectively flooding their bond paper, they're flooding government securities into the market, and consequently the cash which is generated from that pushes itself back into the banking system. And what we've actually found is that the proportion of that money goes into their own domestic economy, but a tremendous amount of it actually goes overseas and it goes chasing yield, because yield is the name of the game. So this chase for yield means that that money actually leaves Japan, and it has some effect on the domestic economy, but as they're finding that it's not really working all that terribly well. So what's the bigger story in Japan? They desperately want a stronger domestic economy, and they're not really pulling it off. They're not really pulling it off. They're managing to do these technical things, such as reducing the value of the yen. But an economy is actually made up of people who work. If you've got an economy and it's full of people and nobody works, then you've really got no great economic interaction going on, and consequently the economy is going to be mired. If, on the other hand, you've got an economy which is absolutely ram-jam full of really hard-working people, their labour gets turned into money, and it's a form of exchange, and the economy will buzz along like crazy. The Japanese have got a demographic problem in that their economy is full of aging people, and aging people become less productive, and not only less productive, they start to become a drain on society because they keep getting ill and they have to go to hospital, and consequently they start to become a bit of a drag on the economy. They are no longer producing enough. And so the demographic problem is that they haven't got enough young people coming along. So that's the dilemma in Japan. If they were to open the floodgates to immigration, as is happening in the UK, then all might be well with their economy, but they haven't, and they've got this major structural problem which is not going to change despite tinkering around with the currency that they've actually got. So that's a bit of a problem in Japan. They've got their specific difficulty to overcome, as have most of the other currencies. Now, let's just take a little look at what is quite an interesting chart, and that is this one. What this chart shows us is on the bottom chart here, we've got the US dollar against the Japanese yen. So it's very much like the chart we've just been looking at, except that this is a daily. And then the chart at the top is the US stock market. It's the ES. It's the futures on the S&P 500. And as we can see, that if we go back to this level, we've got a low in this market. And if we look back a little bit before that, just look at the shape of this in relation to the shape of the ES. There are similarities, not perfect, but there are similarities. And over a period of time, there's been a very good correlation between these two charts. As we can see that from the date of this white vertical line, they have both been moving up very, very strongly. Now, let's just run back a couple of months where we've had, over the last year or 18 months or so, the US gradually and progressively reducing their quantitative easing. Okay? Got to the point where, despite best efforts, then quantitative easing in the US reached massive proportions, and of course the US have decided to bring it to an end. But at the moment they brought it to an end, what happened? Well, the Japanese kicked off with another big round of QE. So if we look at in terms of the Western world economy, QE has not stopped. Okay, we got this temporary stop or slowdown in QA in the States, but that was immediately picked up by Japan. Now, we know that the amount of trade that goes on between Japan and the US is massive. There are also a tremendous number of Japanese companies who do actually manufacture within the United States. So you can start to look at the two economies not as so two totally separate lumps of businesses going on, but there is very, very close interaction. So QE has continued, just happens to be coming out of the States. What's happening to that money? A lot of that money is actually going into US Treasuries. And of course, all sorts of other areas. So we've got this really strong correlation. Now, is it likely, and this is my question to you, is it likely that the US dollar against the Japanese yen will keep on rising? Do you think we have seen the end of it so far? It's now, well, it hasn't quite made it to 120, but one imagines that the rate of increase looks as if that will happen fairly soon. In the last few days, or just this week, we found that it's starting then to move back up again, particularly this morning. Right, well, okay, suggestion is that maybe it's not all that far away from a peak. Well, I mentioned this to you, that I've actually traded the US dollar Japanese yen rate when it was up around 130, 135, 140. Now, that was a good many years ago, but it tells me that it could have still quite a long way to go. And if this correlation stays good, what's that going to do for the US stock market? Seems to suggest that there could be a fair old bit more to go. There could be a fair old bit more to go. Now, just staying with this theme for a moment, I've got a couple of charts to show you. Now, the first one, let's just bring this across. All right. Now, hopefully you can see that all right, guys. So what we've got is what they call the Shiller PE ratio of the US stock market. Price earnings ratios, for us currency traders, well, you probably just don't ever look at them. But I know that a good many people in this room trade both. Trade the stock market, or at least the index. And what this is suggesting is that where it is right now, nudging 27, it's at a high. Okay, it's at a high. If we can compare this to, well, look at that, Black Monday, we got Black Tuesday. We've got times when, where it goes to these highs, it's likely to move on down quite rapidly. If we look back, of course, there was the tech boom, the year 2000, when everything was going potty on the upside, but then it collapsed. And so, there are those who are looking at this ratio and saying, well, look, it's unsustainable at these levels. The market has got to come off. It's got to work its way lower. Indeed, I think if we just go back to, this is the regular PE ratio, then again, if we were to put a line back across here, we could see that this level of around about 20 coincides with a high, and consequently, it's expected to run on down. Well, that's one possibility. That is one possibility. Now, let's just see if we can switch over to, this one. Let's just make this just a GIF larger. And we've got yet another chart of the Dow Jones this time. And what this chart is showing us is that there is, and has been historically, a 17-year cycle. Now, this 17-year cycle, running right the way back, okay, this is the turn of the last century, okay, 1900. Well, a 13 years, 17 years, 17 years, 17-year cycle, 17-year flat cycle, 17-year up cycle. And what it's suggesting is that from the year 2000, we're in a 17-year flat to up cycle, and it could run until 2017, suggesting that there is still a lot more in this market. So is it going to keep running on, or is it not? Well, at the moment, the market is actually telling us that it just wants to keep going on up. And whilst there is this Keynesian continuation of pushing more and more money out there in order to offset the amount of deflation that there is in world economies, as long as this continues, then stock markets will continue to move higher. Right, okay, now what effect is that going to have on currency? I sort of hear you saying there in the background. Well, let's go and look at another chart. Let's go look at some key commodities over here. Let's go look then at this dollar index. Let me just knock off these vertical lines for a moment. And we're looking at a monthly chart. We're looking long term here. None of this is going to make us money in the next half hour. None of it. But it just might give us an impression as to where things are going to be going over the next 5 to 10 years or so. Right, well, what we've seen is that the dollar index has recovered quite strongly. That's where it is right now. We can see that going back to the year 2000, the millennium, where we had the tech boom, we've just seen the chart, and in common with what went on with the stock market, then the currency collapsed. So the currency is going up, okay? Dollar is going up whilst we've got that massive stock market boom going on. Stock market boom turns to bust, down it goes, and what happens to the dollar? It goes down with it. So what that's telling us is that where you've got a booming stock market, it sucks in money from the rest of the world, and the rest of the world starts to buy the US dollar because they need those dollars to buy the US stock market. And of course, all the component companies within it. Right, so what's the market telling us now? Well, it's been plateauing since the crisis, the 2007-2008 crisis, and effectively it's not really gone anywhere apart from come back to where it was just prior to the big crash. Now, of course, there are those pundits out there who are saying, yeah, well, it's all going to happen again. And it's going to happen any time now that we're going to get another big credit crunch and crisis because the dollar has come back to where it was just before the last crisis hit. I was reading that recently. Well, if QE continues and if stock markets continue to boom and we find that the US stock market is leading then, still leading, and it decides to go on higher, could we still have a couple of years to run through until 2017 where this dollar is going to keep rising together with that US stock market? And that seems to be one of the most likely scenarios that there is. Are we going to find that despite the odd short-term setback, the overall move of this dollar is to go considerably higher? And that's really what I'm suggesting that we're going to see, that we could well see continued movement on up, and it'll leave this area of congestion behind, eventually moving through 90, and it's entirely possible that we will see it moving back up to 100 level. Now, let's move over to another market, and let's take a little glance at oil. Now, again, this is not a currency, or is it? Well, it's very heavily traded. It's something that is in demand throughout the world. We can't do without it. And it's been a heavily manipulated market. So it almost qualifies for a currency. Almost. Let's just look at see what had been going on. there we are. That's back to around about 2001, 2002, we get the big boom. We get a little bit of a move on down, and then there was that widely reported Goldman Sachs initiative where they managed to manipulate the price of oil higher, and then they managed to manipulate the bust when it shot on down at the start of the crisis. Since then, we've had price moving up to plus 100, and it's since collapsed. What's behind all of this then? What's behind all of this? Well, there are two conspiracy theories. Well, there are three theories. Two of them are conspiracies. Right. Theory number one, and then we'll get on to the conspiracies, suggests that because of the global slowdown, okay, there is less demand for oil, and because there is so much oil that has been stockpiled and so much oil that has been invested in using QE money, has meant that those stockpiles, now that QE has come to an end, are no longer really quite attractive. And so there's been selling out by a good many large financial institutions, and that is pushing the price of oil down. And together with the reduced global demand, then it's having this sort of general, reasonably dramatic effect on the oil price. Right, so that's theory number one. Let's move on to two conspiracy theories. Conspiracy theory number one is that this is all about teaching Russia a lesson, because the Ukrainian crisis has done several things. It's meant that there's a lot of bad blood between the Russians and the Americans, and it's given rise to a version of the Cold War. We've had the sanctions game, and at the start of the sanctions game, it wasn't having any effect on Russia. So the US decided that they were going to hit the Russians where it really hurts, and that is with their oil exports. They would get together with the Saudis, who are the big, what they call swing producer of oil. The Saudis have got so much of this stuff that they can either turn the tap up or tighten it down a bit, and it doesn't really affect their economy to any great extent. So they got together with the Saudis and said, right, open the taps up, boys, get this oil out there, flood the market, so the oil price goes down, and Russia will not get as much money for the oil that they're exporting after all. Indeed, will drop it down below their cost of production, and that will mean that the Russian economy will be on its knees. It will not be able to invade Ukraine. It will not be able to do anything at all because the ruble will collapse. Well, we've actually seen the ruble collapse. And of course, Pam, you are so right. Yeah, is this going to put a number of oil companies out of business? Well, will. If you consider that the amount of oil exploration going on is very, very expensive deep sea type oil and expensive fracking, which we come on to in just a second for the next conspiracy theory, then you're quite right. It could well be the demise of a number of oil companies, particularly those involved largely in exploration. Right. And the next conspiracy theory is this. The Saudis have been very concerned about all this talk of the US becoming energy self-sufficient from gas, okay, natural gas, of which there is an awful lot in the US and particularly around the coasts. But what about fracking? Right. Well, there's been a lot of talk about fracking having a major effect in the US to make them energy self-sufficient. Now, we do know that fracking is a bit of a dodgy old technology economically. Let's not worry about the sort of the moral issues about nasty water getting into water courses and so on. But the problem with fracking is that it costs an awful lot of money to set up a fracking plant, and you get a nice little return from it initially, but it tails off really quickly. Some are saying that there's about a 3-year life in a fracking well. So these fracking wells are fracking well, not a very good bet long term. But the Saudis were a little bit concerned about all of this, so they thought, oh, right, well, all we've got to do in order to make sure that the US is no longer self-sufficient in oil production is that we will kill their fracking business, and we will do that by reducing the price of oil below the cost, economic cost of fracking, which, there are all sorts of estimates, but they're sort of most accurate ones seem to be hovering around about an average of around about $80 a barrel. Anything under $80 a barrel, and companies cannot make any money out of fracking, so they will not do it. So that's the next conspiracy theory there. Pick whichever one you prefer, or maybe a little combination of all. But one of the things that we have found is that the global economy is contracting. We know it's been contracting because of all the various figures that we have banded out that come out of the Fed, that come out of Europe, that come out of the Bank of England. We know that the economy is struggling somewhat, and we have got a general deflation going on. And that brings us to our next chart, which is gold. Now, the gold chart, well, what is gold? It's just a lump of very nice, shiny metal. And there's a limited supply of it. It increases a bit every now and again when somebody finds a new seam of the stuff. It's supposed to be an awful lot under the sea, but of course that's going to cost quite a lot to get the stuff out of there. But it is used as a store of wealth and a form of money, or at least it certainly has done over the years. There was a time when you'd go along and you sort of buy a new suit and you'd dig out a few gold sovereigns and you'd pay for your suit with gold. There was a time when matelots, chaps who worked on ships, would be paid in gold rings. And where did the craze of having pierced ears among males in the Western population come from? It came from that. Because, if you were working on a ship and you had to go up and sort of hoist the sails and all that sort of stuff, you wouldn't just put money in your pocket, you put it in the most secure place. You put it in a little gold ring in your ear. And that was your store of wealth. And you'd have umpteen of these little gold rings, and you go along, eventually when you got to port and you go and buy something and have a nice night out with a few ladies, how would you pay? You'd pay them in a little gold ring, a tiny bit of gold wire. And so over the years, it's always been there. And consequently, we have found that this gold price mirrors what is going on with the valuation of currencies. Because gold is solid and the value of it is there and it never changes, the price of it will go up and down with the weakness or the strength of an individual currency. And of course, the US dollar is the world currency, like it or not. And as the dollar tends to get weaker, what happens to the gold price? Goes up. Because that brick of gold, the value of that hasn't changed. It's just the purchasing power of the dollar has changed considerably. So we've seen this big run up to 2000, and we've then seen the crash on back down. So there are a couple of things then that affect the price of gold. Yeah, on the edge of it, there's sort of demand from jewelry and so on, but that's only just a sideshow. The major demand for gold comes as a hedge against inflation. So when we've got a lot of inflation, that implies that the value of currencies is coming down and the gold price goes up. The reverse is also the case. The reverse case then is that where there is the opposite of inflation, which is deflation, a downturn in global economies, then there is less chance then of any inflation. Of course there is, and down comes the price of gold. And of course silver, and to an extent, the price of copper, etc. So what this decline in gold is telling us is that the prospects are that there's going to be no inflation, there's going to be deflation, and where there's deflation, then there's a big, big problem, because the debt load throughout the world then is telling us that that debt load is far, far, far too high in relation to the ability of the world economy to keep growing. The world economy is not growing, it is contracting. So the gold price will keep on going down until such time as the world economy does actually genuinely turn round. At the moment, we are getting all sorts of figures that are suggesting to us that yes, we're still hovering, we're going to get 2% growth, the 2% which is said to be the sustainable growth path without getting into inflation. But in reality, the economies are still contracting. And it's while those economies are contracting that the gold price will continue to move on down, and it will be necessary for various versions of QE to continue to pick up that reduction in demand. It's to keep the liquidity going that the whole QE game is about. And 2%, not going to happen. Absolutely, I quite agree with you. And indeed, what we're finding is that we've got inflation in all sorts of areas, particularly in housing in certain parts of the world. Certainly where I am in the UK, it's been absolutely rampant. I was speaking to some people last night and saying, how their houses sort of moved up well over £100,000 in notional value, and it's done so in just over 18 months. Where we've then got foodstuffs inflation, there is inflation at the grassroots level, but until such time as we do get a very genuine move in the opposite of deflation, where we do get genuine growth throughout the Western world, that is when we're going to find that the gold and the silver price will absolutely go ballistic. But until then, whilst we've still got this global contraction going on, and Europe is all part of this game, then we're not going to see any recovery anytime soon, despite the little blip that we've seen as a result of people getting excited over the Swiss referendum this last week. Goldman told us that expect gold to drop under 1,000. Well, I guess it probably will. We got a nice little blue band there. That's picking up a whole series of things technically, very largely Fibonacci based and Elliott wave based. As we can see, we've got this 5-wave move that I fully expect we are going to see gold reach 1,000 before it reaches 1,400. So that's taking a little glance at that. Now, let's just also mention while we're at it, what about the Australian dollar? Because the Australian dollar has been jumping around a little bit recently. Let's go look at a chart of the Australian dollar. I think we've got one here somewhere. Yeah, let's have a weekly chart. And we can see that, look at that. There it was, the Australian dollar against the US dollar at 1.1, and it's been moving down. Now, what is really quite interesting, absolutely. Good point about New Zealand. Good point about New Zealand. What we've seen is that while the gold price has been coming down, the Australian dollar has also been coming down. Now, the Australian dollar, of course, it is a gold currency in that it's not openly linked to gold, but the fact is that they produce a lot of gold. There are a lot of gold mines in Australia. So where you've got the gold price coming off, then it's likely that the Australian dollar will also come on down. Linked to that, their major export market, which is China, and the Chinese slowdown, which was confirmed by the Chinese just over a week ago, where their GDP figures were not looking good, that really does confirm the fact that the Australian economy, which has done exceedingly well in recent years with rampant inflation, particularly in property prices, etc. So we've got this now starting to move on down. And indeed, we had, who was it from the RBA? Was it their finance minister, prime minister, whoever it was, who said, again, just over a week ago, we want a lower Australian dollar. And what we could do, we could actually reduce interest rates still further to achieve it. Now, I don't know if he actually said the figure, but they would dearly like it to be down, not around about 85, but around about 80. So that would be around about 500 pips lower. Now, they may or may not actually achieve that. It may or may not work out for them, but they'll get that. So let's take a glance at, bear with me half a moment. This little chart by courtesy of fxstreet.com, those wonderful people who are very good at coming up with a whole load of statistical bits and pieces, and this is the world interest rates table, very, very useful. Now, currencies are very interest rate sensitive, and indeed, prior to QE, then the major fixation was with interest rates. And it still is. Any hint that a country is going to be putting up interest rates, then that will mean that money will flow into that country. And if we just take a little glance down this, Canada 1%, wow. Bank of England 0.5%, 0.1%, Japan, Europe, what? 0.05%. We'll come to that in just a second. And then the Fed, 0.25%. But look at this, the RBA, Reserve Bank of Australia, and indeed New Zealand, but look at that, they have got the highest interest rates of the Western world. New Zealand even higher. And they are suggesting that they just might want to reduce this even lower in order to try and get their currency to come down. Domestically, though, they're in a bind, because if they do bring interest rates further down, that actually could have the effect of increasing asset price inflation, meaning that houses could go back up to being on the ballistic territory of being ridiculously high in relation to the affordability of the average person. And we certainly found that in the UK. We found that in the UK, where a lot of hot money has been betting on the UK economy, and consequently overseas investors, particularly Hong Kong investors, have just been buying blocks of flats, sight unseen. We're buying. If they're bricks with a bit of cement between them, we will buy it. And of course, it's gone to an extent now that it starts to become unaffordable for the average person. And that's exactly the problem the Australians have had, and in pockets of New Zealand, particularly Auckland, that is well and truly the case. So where we've got this interest rate game going on, we're finding that with the Australian dollar, that whenever we get these little comments coming out of the Reserve Bank, Royal Bank of Australia, suggesting that they must get this lower currency, then there are those who will buy into the Australian currency for the yield, So, worth mentioning a carry trade, that if you are long the Australian dollar, okay, and say short something like the Japanese yen, then you will make money just holding the currency, just holding it. However, if you're short, it costs you money. So this is an expensive short because you have to pay the carry when you are short. Right, okay, now I mentioned the euro, so we better not gloss over the euro. Let's run over the euro. Now, again, we've got this weekly chart. We've got various areas of interest, and this is one and truly one. Let me just bring this across because that's where we are right now. The Eurozone has gone through, as we know, all sorts of machinations from the point where there's this cacophony of pretty well every man, woman, dog, child, economist, central bank governor telling us that the euro was doomed and that the euro, because of the debt problems with the periphery of the PIGS countries, Portugal, Italy, Greece particularly, was going to lead to the demise of the euro. But there are those who started to say, like Draghi, we will do whatever it takes, etc., to jawbone it, to make sure that it wasn't going to collapse. But what they desperately do want is a weaker euro. The euro is uncompetitively strong, and there's a real big problem. And the problem is that if you compare the euro against the Japanese yen, then with the Japanese yen getting weaker and the euro getting stronger, and there we go, we've got the euro getting really strong against that Japanese yen. This has a major effect. Think of the car trade. What comes out, a luxury car that comes out of Japan is a Lexus. Luxury, well, semi-luxury car that comes out of Germany, call it a Mercedes or a BMW. But as the euro gets stronger, the cost of those Mercedes and BMWs to, I say, a US purchaser starts to either get too expensive in relation to the more competitive Lexus, so it starts to reduce the performance of the German economy in relation to what is going on with the Japanese economy. It either makes those BMWs and Mercedes more expensive in relation to the Lexus, or indeed BMW have to suck it up and accept that they are not going to make as much money on every BMW, every Mercedes that Mercedes-Benz sell. So it's having a dramatic effect on the European economy, particularly the Germans. And what is really quite interesting is that the Germans are the very people who are saying to Mario Draghi and the ECB, you are not going to get into big QE. We believe in sound money. We do not believe in a tremendous amount of money being pushed into the economy. And indeed, just last week, Mario Draghi said, oh yeah, we're going to do it. We're going to buy, it's asset-backed securities time. It's CLOs. It's all of these things that we are going to buy, and we will push this money into the European economy, and it will collapse the euro. And for a day, the euro did collapse. One day, one single day. And then there was an official, one of Mario Draghi's fellow board members on the ECB came out and said, "Oh no, we're not going to do that. We're not going to do that. The Germans won't allow us to do it. They believe in sound money. No, we're not going to do it." And the euro immediately strengthened against that. So, what's going to happen to the euro? What's going to happen to the European economy? Well, I maintain it's just going to continue as it has done really over the last few decades of being a very, very, very slow growth, negative growth in a good many parts of the euro economy. And that's what it's been like for really as long as I can remember. I mean, you'd never look on France as being a dynamic economy. It never has been. It probably never will be. The periphery, well, it's never going to happen. And what about Italy? Well, Italy is Italy, and it just struggles along in its own sweet way. What about Spain? Are we going to get... No, it's just not going to happen. So the only sort of various powerhouses within the euro economy are Germany, and that's now struggling, and one or two of the other northern European countries. But overall, it's just going to stagnate, and we're not going to see anything happening massively anytime soon. But we may well find that eventually we will get this big decline in the euro, eventually moving down to maybe 1 to 1 for the dollar, not because of QE, but because of the general European economy stagnating and just not being able to really pull itself up out of the mire. Yeah, right. Sorry, comment there, coming back. Yeah, absolutely. Yeah, that's where you're going back to gold, mirror of the dollar index. Indeed, indeed. Right. Okay, guys. Well, that's having a little glance at some of these major drivers that there are at the moment, with a few conspiracy theories thrown in. So what I'm really coming back down to is to suggest that this rally in the dollar index, despite the fact that we will have corrections along the way, it's got a lot further to go. It's got a lot further to go. So I can see the dollar moving higher. I can see the euro probably spending a little bit of time where it is right now, but gradually meandering lower. And the one that we've not really mentioned too much about is the GDP USD. Far too many lines on here. As you can see, I've got my sort of harmonic software, which absolutely works a charm. But if we consider what's going on with the UK economy, then we've had this sort of growth. We've had immigrants, which have been really, really helping the UK economy boom. But regrettably, the indebtedness of the UK economy seems to be growing at an ever faster rate, faster than the improvement and the increase in GDP that we've seen. And the UK goes through these processes every now and again. Sometimes it takes quite a few decades for it to all unfold. And I think the market is starting to get a little bit jittery that the ever increasing amounts of debt, when the UK economy eventually turns down, will be just all a bit too much for it. We could end up then with a much lower pound against the US dollar. And that's exactly what we've been seeing. We've been seeing then the double effect of a strong dollar and then a potential further weakening in the general competitive position that there is of the UK. So on down, it has been coming. I guess it's going to stay in this general area for some period of time, but it certainly is vulnerable to considerable further moves on the downside. Right. Okay. Now, the only thing I've not actually mentioned in all of this, and that is the Canadian dollar. So we've run a little bit over time here, but indulge me just for a moment. Let's just look at the USD against CAD. There is a bit of a double whammy effect on this. Now, the Canadian economy has gone through all sorts of machinations. And domestically, with things like house prices, well, they've had the boom and they've had the bust. Um, but we've also got to keep in mind that the Canadian economy is very much an oil economy. And as the price of oil comes off, then that has a major effect on the CAD. And we've seen then that the US dollar continues to get strong against an ever weakening CAD. So link this to the oil price and you'll start to see what happens. There's an inverse correlation between the US dollar against the CAD and the oil price. So Canada cannot survive with a weak oil price because so much of their oil comes from shale, and the cost of converting it and then transporting it means that they need a plus $100 oil price in order to survive. Right, okay, folks. Well, I'm going to call it a day there. We've covered a fair bit of ground on some of the longer term things, bits and pieces. I'm going to leave you with one of my favorite charts. And here it is. This is the US debt clock. Now, I want you to look at this number. The US national debt. Look at that. See that number? 5. There are a lot of digits after it. Trillion. But, wow. When was this? Look at this number. The year 2000. The year 2000. Okay. That was the millennium time when we had the tech boom that came to an end. But if we bring this now up to 2014, it's in there somewhere. Here it is. Look at that. From 5 to 18. From 5 to 18. Debt per citizen, and because there are far fewer taxpayers than there are citizens, there we are. Every taxpayer is on the hook for $150,000. Now, we could, of course, look somewhat further on this one, and by 2018, it will have increased really quite substantially still further. So there we are. Will this eventually be the demise of the Western world in the way that the Roman Empire eventually collapsed because of too much debt? I leave you with that comment and to your own conclusions. Thanks for being with me. Look forward to being with you just after Christmas.